Welcome back to America's Commercial Real Estate Show. I'm Michael Ball. This segment is brought to you by CommercialAgentSuccess.com. It is cloud-based video training for commercial agents. Check it out at CommercialAgentSuccess.com. Today we're talking about the financing market, the capital stack. Boy, does it have such an important role in commercial real estate. My guest is Tom Fink, and he is Senior Vice President and Managing Director with Trepp. And Tom, one of the things I think is on everyone's mind is how long are these good times going to last? You certainly have your finger on the pulse, especially with all the clients and people you talk with every day. What do you say?
You know, there have been a lot of people that try to guess what inning we're in. There are different ways of phrasing it. I think we're well advanced in the cycle, but I don't know if we're at a point where property and commercial real estate is seriously overvalued or overextended. I remember, and I'm sure you remember back in 2007 and 2008, when property values just skyrocketed. And I was always saying to people, we'll never see, I don't think we'll ever see property values get back to these levels. I don't think I'll see it the rest of my career. Well, I was wrong. Property levels have surpassed the level of 2007 and 2008, which means one of two things. One is I should have retired by now, or two is I'm a lousy prognosticator. It's probably the latter. But when I look at the long-term trend, I don't think properties are overvalued right now. I really don't. Are people stretching the envelope to maximize the dollars they're getting out of it? Yes. But there is still an awful lot of very sophisticated capital on all sides of the capital stack. I don't see any silly money at this point. And I'm talking to, people that are running, mixed books at insurance companies, mortgage REITs, private equity firms, asset management companies that are doing a huge chunk of commercial real estate and other alternative assets. The market is not, I don't think it's seriously overvalued like it was in 2007 and 2008. So if we do, what's going to trigger the end of the cycle is when the economy enters a recession. And the reason I say that is a recession will start to create a drop in demand for commercial real estate. Now, it will not be uniform across the board. It will not be uniform by markets. It won't be uniform by property type. Right now, I would argue that in many retail markets, we're already way past the peak of the cycle. We're in a downturn, particularly for, your what's the right way to put it? I guess they call them B and C malls, but your middle market mall that depended on a couple of department stores as anchors to drive traffic into the whole mall. That whole sector has been decimated. We've got Sears talking about complete bankruptcy and folding its doors, which would take Kmart with it. We're talking about a number of the department stores continuing to have problems with their business model and their strategies. So that diversified retailer, that department store mentality of you have a little bit of everything, I think that's the retail model that's under a lot of pressure.
Yeah, and of course there's some retail that's doing really well in some areas and some property types. Retail is just doing splendid. So are some lenders kind of bulking all retail together and kind of staying away from it, or are lenders really looking at each deal very carefully and still doing retail?
I think lenders look at each deal very carefully. I don't think. I think there is probably credit policies that say we're going to take a closer look at retail. Just like when, if you've got a market that's overbuilding on, high-rise condos, we're going to look more closely at high-rise condos.
Right.
We're going to be a little more stringent, but that doesn't mean we're going to blacklist a property type.
Right.
The only property type, looking at the market that has people have just pulled away from and not come back to is the hotel sector. and lodging. You have some very strong lenders in that space. You have some very dedicated investors in that space, but you don't have people making hotel loans just because it's a piece of commercial real estate. The people that are in that market now, I think, are specialists. I think the same thing in student housing. So there are some specialty property types that you're not going to find in the general purpose commercial real estate portfolio. So that's what I think.
Yeah, and I think that's smart business, right? The lenders should stay, in their strike zone.
Yeah, I think there's a misconception, and I see it for people that are not in the market. They think commercial real estate is just, it's a single asset class. Mm-hmm. And you and I both know that, it's like every other business. There's specialties within specialties.
And let's talk about multifamily. I think some people are concerned maybe there's some overbuilding in certain markets. What do lenders think? What do you see?
I think at the high end, we're definitely, in some markets, we're overbuilt. It's getting harder and harder to move things at the top of the market. There's still flight capital coming in from around the world. I mean, owning a piece of real estate in New York is still, the perception is it's still a long-term bank account. And, that's good for New York. But I think if you go beyond the top of the market, there's a serious need for, workforce housing, affordable housing, middle-income housing, however you want to put it, but just more variety in the price points in the housing stock. Look, I mean, in New York City, a low to moderate income is up to like $80,000. Mm-hmm. But you need those kind of property because there's an awful lot of people that, are trying to make it in New York City that aren't pulling down anywhere near six figures. So you've got people that are, piling 2 to 3 different incomes into an apartment and sharing space because it's the only way you can afford an apartment. But I think there's definitely a need for more diversified price points in the housing market, particularly in the middle to lower ends of the sector. And I'm not talking about low-income subsidized housing. I'm talking about people that live in an apartment because that's what they can afford. So it's the not rent by choice, but rent out of necessity.
Right.
And I think, there's a lot of organizations. I think Freddie and Fannie are both trying to find a way to increase the capital in those markets. And you know what? Some of those can be nice cash-flowing properties. I mean, you get them rented up, and people are going to be there a while. And you take care of it so that it's a nice, comfortable place to live. And you'll be clipping coupons for a long time.
Yeah.
Which, when you look at real estate, what does real estate give you as an investor? Current cash plus an inflation hedge.
Exactly. And I think multifamily is interesting. I had a client who develops all types of properties, retail, office, and multifamily. And he had started in multifamily. It was in the last downturn. He was having some issues with his retail properties. And he told me, he said, Michael, he said, never again. I'm going to stay with multifamily. Multifamily's simple. If your vacancy starts going up, lower your rents. You're good to go, right? It's pretty straightforward. Well, I want to ask you, Tom, you're in the middle of the financing world. What are lenders concerned about right now? Or is there anything out there? Is it the economy? Is it rising rates? Is it competition? What concerns lenders?
Well, I think competition is a big concern. I think there is so much money in commercial real estate that it's not like shooting fish in a barrel anymore. You have to bring your A game all the time. And I think for some lenders that's a bit of a change. And I think people are just trying to stay on top of credit concerns. They don't want to give up too many covenants. They don't want to give up an ability to do recourse and go back to the parent to squeeze them to put more money in a project. And obviously on the borrower side, they're looking for as much non-recourse as possible because if the business of a particular piece of real estate goes down, they want to be able to get out of it if that's the rational decision. I think that's something we've seen a lot of on the retail side. You know, some of the big developers, they're very, very disciplined about, you know, continuing to evaluate their portfolio. And if a property starts to decline and they think they're not going to be able to invest enough money to bring it back to a profitable level, they'll let that sucker go. they'll put it back to the lenders and say, "Here, this is your problem now."
What do you
I've
see?
had enough.
And what do you see, Tom, for delinquency right now? Is it what's the trend there?
The trends have been, Michael, delinquencies are I don't want to say they're not at record lows, but they're way down, and they continue. Even though there's been some spike up in delinquencies in certain markets and certain property subtypes, overall delinquencies continue to be benign.
Good. Tom, what would you leave our audience with to maybe you're talking to a lender or a borrower today?
Be skeptical. If it sounds too good, it probably is.
Always good advice. Tom, thank you for joining us today. We appreciate your intel, sir.
Michael, it's always a pleasure to talk to you and your audience.
Thank you.
Have a great holiday season.
You too. Well,
Bye.
Thank you for joining us around the world, around the country. Thanks for checking in with us on Facebook and LinkedIn and Twitter, and thanks for sharing the show. And until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show.